Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Zomedica's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Zomedica develops and markets pharmaceuticals for pets. It created Truforma, which will help vets diagnose pets much faster than other devices. It is a blood testing kit for veterinarians. It is based on bulk acoustic wave sensors from the company Qorvo, ticker QRVO. The waves run through the pet's blood sample to test for adrenal and thyroid diseases. The cost to buy Truforma is $8,750. The device is protected by 70 issued and pending patents. The global diagnostic market for animals was $6.2 billion in 2020. The US market is about 1/3 of that. The company acquired Pulse Veterinary Technologies for $70.9 million in an all-cash deal. This company develops electro-hydraulic shockwave technology for the treatment of a wide variety of animal conditions. The technology is used in conditions affecting tendons, ligaments, osteoarthritis, chronic pain, and wounds. They are the leader in the equine space, with 1,500 of their systems currently being used. Larry Heaton has been appointed president effective October 1st of 2021. He assumed the role of CEO after Robert Cohen retired. Larry has 35 years of experience in the medical device and biotech industries, with a focus on commercialization and business development. The company is headquartered in Ann Arbor, Michigan, and was founded in 2013. It trades on the New York Stock Exchange and TSX Venture. Let's get started with the model. This is a small cap company, 343 million market cap. They're trading at 35 cents a share, and they have 980 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have negative free cash flow each year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is a sales for the company, and that was zero in 18, 19, and 20, but a small positive in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. That was zero each year until the trailing 12 months. They had 52,000. Below that is their operating expenses. These are all the expenses to run the day-to-day business. Research and development is a big operating expense for this company. Revenue minus operating expenses give you your operating income, which is negative every year. They spent $6,000 of interest on their debt. They received $273,000 of interest on their investments. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. An example is a gain on the disposal of an asset or the loss on an asset impairment. Below that is their pre-tax income, then their taxes, which is zero every year, and the bottom line of the income statement is their net income, which is negative every year. This is the income statement from their quarterly report, the first 9 months of 2020, the first 9 months of 2021, the third quarter of 2020, and the third quarter of 2021. They had $23,000 of revenue in the third quarter. This is from the sale of Truforma. Also the sale of warranties that go along with that product. Below that is the cost of revenue. These are the expenses directly related to making that product. That was $18,000, and they had a $5,000 gross profit. So they're bringing in thousands of dollars a quarter. They spent $288,000 of R&D. Last year was $2.7 million. Selling, general, and administrative expenses is payroll and stock-based compensation. That was $6.1 million. Last year was $2.3 million. So they had an operating loss of $6.4 million. Last year was $5 million. They earned $94,000 of interest from investing the cash from their IPO. So the interest they earn on the cash in their bank account is more than the revenue they're bringing in. They had a gain of $27,000 from the disposal of an asset. They had a net loss of $6.3 million. Last year was $5 million. In the first 9 months of 2021, it was a loss of $15 million. Last year was a loss of $12.7 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They spent $358,000 of CapEx in the trailing 12 months. Operating cash flow minus CapEx gives you your free cash flow. Since they have negative free cash flow, they need funds from somewhere, so they're issuing stock. They issued $15 million in 2019, $56 million, then $199 million. Every time a company issues common stock, it increases the shares outstanding and makes your shares less valuable. Here's their operating cash flow section from their statement of cash flows. This is from their 9/30 quarterly report. And this is the first 9 months of 2020 and the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net loss, then you have to add or subtract the non-cash items on the income statement and adjust for changes in working capital. So we start with the net loss of $15 million, we add back depreciation, amortization, we add back the loss on the disposal of property and equipment. Their main expense is stock-based compensation. They issued $500,000 last year, it was $4.5 million this year. All the shareholders are losing money, but at least the executives are getting paid. They purchased $1.9 million of inventory to develop Truforma. That's a cash outflow. When they sell that inventory, then it goes onto the income statement as revenue and as a cash inflow. They added $3.2 million of accounts payable to get that inventory. When a company takes on accounts payable, it's like a loan, but instead of receiving cash, you're receiving a product. So it's a cash inflow, but when they pay that loan, it'll be a cash outflow. Even though they reported an accounting loss of $15 million, they actually lost $9.4 million of cash flow. Here's the investing and financing sections from their statement of cash flows. It looks like they acquired some businesses, $245,000, and they bought some property and equipment for $97,000. In their investing section, they had a cash outflow of $342,000. In their financing section, they had a cash inflow of $199 million from issuing common stock. Last year was $56 million. Sometimes companies issue warrants. These are options where the holder of the warrant can purchase a common stock at a predetermined price. They raised $32 million from that. They raised $1.8 million from the exercise of stock options. And when they issue common stock, there's fees involved. They pay $14 million of fees. In their financing section, they had a cash inflow of $219 million. Last year was a cash inflow of $64 million. Here's the equity section on their 9/30 balance sheet. They raised $387 million from selling their business, and they lost $116 million from running their business. Let's look at the capital structure. $272 million of equity, $1 million of debt. So they're 99% equity, 1% debt. Their net debt is negative $270 million, and their WACC is 9.5%. I gave them the highest WACC on Finbox, and that's the discount rate we're going to apply to the future cash flows. We estimated 7 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 7. That's $659 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $413 million. We divide that by 980 million shares, and we get a calculated stock price of 42 cents. They're trading at 35 cents, so they're trading at a 17% discount. It's a buy according to the model. It's really difficult to value this company. They're not really bringing in much revenue, and they did not provide any revenue targets for the future. I just took an easy approach and said they would have $300 million of revenue by 2027, and I just backed into that number in the prior years. The average company in their industry converts 15% of their revenue to free cash flow. So I multiplied their future revenue estimates by 15%. That's how I got their future free cash flows. So if you think they can hit $300 million of revenue by 2027, then the stock is probably a buy. If you don't think they can hit these targets, then you should probably pass. This is where the stock has been trading the last 2 years. There was a lot of trading activity. This stock was really popular in the Reddit community, and they pushed the stock price over $2 a share. It was trading really low, well below $1. So some people made 10, 20, 100x on this investment. As you can see, there's been a pretty big sell-off, and the stock price has been coming down. And I think it'll continue coming down. Unless they start bringing in a good amount of sales, I can't see how it's ever going to get back to these numbers again. They have a beta of 0.4, so the stock moves less than half the market. It's gone down 68% in the past 52 weeks, while the S&P 500 went up 23%. The 52-week low is 31 cents. The high is 291, and the stock is trading below its 50-day and 200-day moving average. This stock always has lots of trading activity. Nearly 17 million shares are traded each day. Of the 980 million shares outstanding, 955 million are on float. 15% are held by institutions, and 8% of the shares are shorted. Their employee count peaked at 28 last year, but they cut 9 people. They're at 19 right now. If you invested $10,000 into this company when it IPO'd, you would have lost 85% of your investment. In the past year, 6,400 shares have been sold by insiders, 500,000 have been purchased. Christopher McLeod sold 6,400 shares at $1.10. That was a good sale. Johnny Powers bought 500,000 shares at 45 cents each, so he's down quite a bit. The biggest shareholder is Vanguard at 4.25%. They own 41.5 million shares, valued at $14.5 million. The next is State Street, then BlackRock, Savvy Management, and Cambridge Investment. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price of sales is on another planet, 6,500, and they have a really good price to book at 1.3. Let's look at their non-current assets. 168,000 of prepaid expenses, 700,000 of property and equipment, 1.4 million of right-of-use assets. These are assets the company uses that are owned by another company, and 500,000 of intangibles. They have a really high current ratio and quick ratio. Let's look at their current assets. 271 million of cash, 1.4 million of inventory, 1.6 million of prepaid expenses, and 250,000 of other. Let's look at their current liabilities. 4.5 million of accounts payable. This is how much Zomedica owes other companies, and 400,000 of lease obligations. Even though they had negative 12 million of free cash flow in the trailing 12 months, they have lots of cash. They have 270 million of working capital. So they do have enough funding to get through the next few years without needing any more debt or equity. The best way to look at ratios is to compare them to companies in the same industry. There are 94 companies in the same industry as Zomedica, and Zomedica doesn't have good ratios since they're pretty much pre-revenue. They rank 36th in market cap at 343 million. The average is 3 billion. They are doing a lot better in price to book at 1.3. The average is 6.2. But every other category they're doing pretty poor in. So to summarize, I have them trading at a 17% discount. But this company launched at the worst time, during COVID. Unfortunately, animal health took a back seat, especially a new product like this. Everybody was focused on not getting COVID. So if this company does have a chance, we might find out this year or next. I rank their free cash flows, revenue, and ratios 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member on my YouTube channel or on Patreon by clicking on the link in the description below. Thanks for watching.